If you trade the BTMM, but you don't understand these 5 moving averages, you are missing some crucial trade confirmations. The 5, 13, 50, 200, and the 800 EMAs, which are also known as the Ketchup, the Mayo, the Water, and the Blue Taser, are the backbone of the BTMM strategy. They help you identify the market structure, trade entries, and trend direction. Now, in this video, I will break down exactly how you use them for sniper trades. What are moving averages and why do we use them in the BTMM strategy? Now, moving averages help smooth out price action and identify trends. All right. In the BTMM strategy specifically, they are used to confirm the market structure, reversals, and entry points. So where do we use exponential moving averages instead of the simple moving averages? We use exponential moving averages because they react faster to price changes. And they also provide better confirmation for BTMM traders. Now, let's break down each of these 5 key EMAs, their unique BTMM names, and how you use them. Each EMA in the BTMM strategy serves a specific role. Let's go step by step. Number 1, we have what we call the 5-period exponential moving average. On my chart here, it's marked red. In other words, or the BTMM name for it is the ketchup. Now, the ketchup is red, right? So, what does it do? The 5 EMA is the fastest moving average and it reacts quickly to price changes. So it helps us identify sniper entries and exit points. So we'll be able to know when the market is about to do what we expect, and it will also be able to tell us when we should exit the trade. How do we use it? So the 5-period EMA, right? It will tell us when we are going to take the sniper trade, and this is how we do it. We will buy when the price crosses above and retests the 5-period EMA. For example, we can see here on pound yen, the market crossed above, then crossed back up again, and this time it retested the 5 EMA. How do we know it's a retest? We have rejection along the 5-period EMA. This is what we call a retest. Now, this confirms that you have your trade. But when you compare this here and this one here, this is not a retest. The market broke up, then it broke back in, right? But the confirmation comes in once we have the market go back up and then it fails to break down again. That becomes your trade. And then we will get a sell when the price crosses below and retests the 5 EMA. So for instance, here we can see the market breaking below and retesting it or failing to break above it again. So here we get our entry and the market drops. Now, the 5-period EMA is called the ketchup because it moves fast and it is your trade trigger. So the moment that rule is set, then you have your trade. So supposing you know you are looking for a buy, right? Because maybe you are at level 1 peak formation low or level 2 peak formation low. So once the market sets the structure, the market is trading above the 5 EMA, it retests and fails to break below, you get your trade. All right, let's go to the second EMA, which is the 13-period moving average. On my chart here, it is marked yellow. All right. The 13-period EMA is also known as the Mayo. All right. The mayonnaise is usually yellow, right? So our moving average here is marked yellow. And what does it do? The 13-period EMA, it acts as a short-term trend filter. And this means it confirms whether the momentum is strong or weak. You will be able to tell that you are in a good trade or you are in a bad trade. For instance, let's look at this. So the market breaks above and we have a cross of the two EMAs, meaning we get our trade right here. Our stop loss goes below the structure, right? So you have your entry. You have your entry right there. And your stop loss goes below the market structure, which is right there. The market played around almost back to the same level, but never broke it. And they went back into the direction that you are taking the trade. And this was a very nice trade. Now let's look at another example. Here we have the markets form a nice double bottom, right? First leg, second leg, the retest is right here. We have our trade, also the cross happens here. So we have a trade right here, and our stop loss goes right below the market structure. So here is your double bottom, here is your cross, and you have your trade all the way to your 50 EMA and the 200 EMA. Okay. So how do we use it to take trade? Now, for a bullish setup, the 5 EMA must stay above the 13-period EMA. Or in BTMM terms, the ketchup must stay above the mayo. And if that happens, we have a strong buy signal. For a bearish setup, the 5 EMA must stay below the 13-period EMA. All right? In other words, the ketchup must stay below the mayo. And that means we have a strong sell signal. Now, think of the 13 EMA as the mayo. The mayonnaise, usually it is smooth. In other words, what we are saying here is that the mayo smooths things out and confirms the momentum in your direction. All right, so look at an example. When the market crosses above the 13-period EMA, it means the momentum is high. You can see here. So the 13-period EMA will help you know whether you're in a strong momentum or a weak momentum. Number 3, we have the 50 EMA, which on my chart here is marked as the light blue. Okay? The light blue. You see how the ocean looks like or the water looks like? It is marked blue on my chart. So why is it called the water? The 50 EMA is called the water because it keeps the market structure flowing. What is the work of the water? In a river, in an ocean, it flows, right? It flows. So now the work of the 50 EMA is to keep the market structure flowing. So what does it do? The 50 EMA confirms the market structure, whether the market is bullish or bearish, and then it also serves as a dynamic support and resistance, meaning that you would be looking to book your profit or take your trade at that particular moving average. How do we use it? When the price is above the 50 EMA, we have an uptrend, and so it means we look for buy setups. And when the price is below the 50 EMA, we have a downtrend. That means we are looking for sell setups. For example, when the market is above, we are looking for buys. And when the market is below, we are looking for sells, right? When the market is above, we are looking for buys. When it's below, we are looking for sells. However, you must be trading at the levels you are supposed to be trading. What do I mean? If the market is bearish, you are looking for sells. So you have your structure here. This is a nice double top. market shifts. It's below the 50 EMA, it's below the 13, it's below the 5. The momentum is strong, the trade is locked, you can take your sell and you can see there's a huge drop. So the 50 EMA confirms that we have a downtrend in this case, right? And because the market is below the ketchup and the mayo, it means the momentum is high and we have a sell signal. Same case happens here. The moment the market breaks above the 5 period, the 13 period, and the 50 period EMA, we have a very strong momentum to the upside, right? Meaning that we get our nice market structure. You can see the double bottom form here, right? Leg 1, leg 2, the market goes back up. It retests our 5 period EMA, which is our rule. We have our trade. The market is above the Mayo, and it's also above the water. And you can see what happens. The price took off. Okay, let's go to our next moving average, which is the 200 EMA. Now, the 200 EMA is marked blue on my chart. We call it in BTMM terms, the blue Taser. Now, let me ask you a question. What is the work of a Taser? The work of a Taser is to shock. Now, what's the work of the 200 EMA, or what does it do? The 200 EMA confirms the overall trend direction on higher time frames. Higher time frame is 1 hour, 4 hours, daily, and weekly and above. It confirms the overall trend on the higher time frames. Number 2 is that it will act as a major support and resistance for big reversals. All right? It will act as major support and resistance for big reversals. So how do we use it? When the price touches the 200 EMA, often it signals a potential reversal, but always wait for confirmation before entering your trades. When the price reaches the 200 EMA or the blue Taser, be ready for a shock in the direction. Let's see if we can get an example here. All right, so the market generally was going up very well, very well. Once it interacted with our 200 EMA, the trend changed. All right, every time it interacts with the 200 EMA, the trend changed until we got now a change of direction and the market started flying up. But you can see here, every time the market comes to the 200 EMA, we get a bounce. We get a bounce, right? That is the key work of the 200 EMA in the BTMM strategy. And the same situation is repeated severally. If you go back and see how the market behaves when it is reacting to the 200 EMA, right? You can see, always expect a shock in the trend direction when the market is interacting with the 200 EMA. The final moving average, which is the 800 EMA, it is marked black on my chart, as you can see it here, right? And the 800 EMA is also known as the market maker's invisible wall. The market maker's invisible wall. I like to call it the dead pit or the market maker's dead pit, right? Why do I say the dead pit? Is a trap zone. So what does the 800 EMA do? It marks the long-term trend direction and reversal zones, meaning that once the price hits the 800 EMA, expect a long-term reversal, okay? And it is also used by market makers to trap retail traders. People who trade moving averages will be believing because the market is bearish, it will still continue selling. And so they'll be placing their sells along that particular moving average. And that's where they get caught up, right? That's where they get caught up. For instance, if you're trading here, the market is bearish. But if you're caught up when you're trading at the market maker's invisible wall, what happens? The market issues a double bottom and rises almost 50, 100 pips against you. You can see this one here. So this is a very huge move. Okay, let's see. The market comes, interacts with this invisible wall, and we have a huge reversal. How do we use the 800 EMA when trading the BTMM strategy? If the price reaches the 800 EMA after a big move, expect a possible reversal. Okay, look forward for a reversal. So here we have a huge move of how many days? 1, 2, 3 days, and we look for a reversal. Look at where it happened, at our invisible wall. We have a huge move, drop down at our invisible wall, we get a bounce back up. Okay, look at here. This was actually Friday before market close. Market pushes up at our invisible wall, we get an M formation and the market drops big. All right. Now, the 800 EMA is called the market maker's invisible wall because when the price hits it, we expect manipulations. We expect a reversal, and a reversal doesn't just happen. A reversal comes after the market has topped out several traders and has hit a lot of orders. All right. So how do we combine these exponential moving averages for high quality trades? Now that you know what each EMA does, let's see how we use them together for sniper trades. All right. Now, EMA crossovers. When the 5-period EMA crosses above the 13-period EMA, we have a bullish confirmation. When the 5-period crosses above the 13-period, we have a bullish signal or a buy trade. Okay? When the market or when the 5-period EMA crosses above the 13-period EMA, we get a buy. When the 5-period EMA crosses below the 13-period EMA, we have a bearish reversal or trade. And when the 5 and 13 period cross below the 50 EMA, we get a bearish confirmation. Let's look at that. When the 5 and the 13 cross the 50 period EMA, which is the blue one, the light blue, we get a bearish confirmation. Look at that one. Look at that. When the 5 period and the 13 period cross above the 50 EMA, we get a bullish confirmation. Look at that. And when they break again, we get a bearish confirmation. That's all it is. That's all it is. Okay, then number 2, we have EMA bounces. So we just talked about crossovers. Now let's talk about bounces. Now, price rejecting 50 or 200, which is either the water, the blue one, or the blue Taser, okay, we get a trend continuation. When the price rejects the 50 or the 200, we get a trend continuation. And then we can also get price bouncing off the 800 EMA. And that's where we say we expect a possible reversal. It can either be the 200 or the 800 EMA, and we expect to see a reversal. Now, using these EMAs together will help you avoid fake outs and enter trades confidently, because at least you know what is about to happen. So when you have the market interacting with the dark blue and the black EMA, which is the 200 or the 800, expect a market reversal. Okay, expect a market reversal. Okay, so you can also use these moving averages as your take profit zones, right? Like for instance, once you execute your trade here on this cross, you can have your take profit 1 and your take profit 2. Okay, if you execute your sell here, you have your take profit and another take profit. All right, if you executed this trade, you have your take profit 1 and your take profit 2. So you can use them to book your profit. Now that you understand the 5 EMAs of the BTMM strategy, the next step will be to practice how to use them for sniper entries. Remember, you cannot learn everything in one day, but practice makes it perfect. Now, in our next video, we will break down how to trade EMA crossovers, retests, and bounces for high probability setup. Make sure you don't miss it. So hit that subscribe button and turn on the notification bell right now. And by the way, if you want to master price action and candlestick patterns, I shared a candlestick Bible, which is a PDF, a very nice book that will help you overcome your struggles with price action. You'll find the link for that book in the description below this video. Thank you so much for taking your time to watch this video. I hope to see you in the next one. Peace out.